US markets have been doing really, really well. Obviously, Donald Trump is trying to drive a wedge between himself and Joe Biden and saying that, Wall Street, the S&P doing really well, and he's clearly trying to take a bit of credit for that. I guess a little bit of our own fact check type thing. Are markets in the US doing really well? If they are, how much of that do you think is due to anything at all that Donald Trump is doing? And is it basically the companies on those indices across the board, or are there a few outliers who are really shooting ahead, and that's what are they leading the pack, or is it across the piece?
Yeah, I think there's a lot in that question, and we could spend a lot of time trying to answer all of them. I think if we take a step back and we think about an election year in the US, what is the economy is really important. Ultimately, as we've seen in previous elections, if the economy is doing well, the incumbent tends to get re-elected. One would probably argue at this point in time the economy is being challenged. If we just think about the numbers that George mentioned there at the start, in terms of the overall number of jobs that have been lost, that is a difficult electoral backdrop for an incumbent president to be dealing with. Albeit, yes, it has improved from sort of 18.7, 18.6 million at the height of the challenge, but it's still 16 million people. And if we try and put that into context, there's been about 14.3 million jobs that have been lost in the US in this COVID situation that we're trying to deal with. So that's the backdrop that he's dealing with. And I think you're right, Peter, in the sense that he wants to deflect that somehow. It's easy to try and deflect it onto what Biden's doing, but Biden hasn't really said very much yet, which I find quite interesting from the presumptive Democratic nominee. The other side of it, as you touch on, the market is doing well. So people will be seeing that in their 401k plans that US citizens have. But then again, it's a relatively narrow part of the market that's doing well. And a large proportion of that is being driven by Facebook, Apple, Amazon, Netflix, Google, and Microsoft as well. So those sort of 6 stocks have been very important to the overall performance of the S&P, and indeed they account for some 27% of the S&P 500. So I think that's one of the things that when we as a team are talking about and discussing the US, you have to try and separate what's happening in the economy versus what's happening in the stock market, because at times those two things can be very disconnected, and that's important for us to think about as a team, think about when we're looking at our true potential portfolios, and also in the discussions that we're having with the managers as well.
And Jeff, would those, I think we call them the FANGs in your investment sort of terminology, would they normally be the companies that are far out ahead and really leading the pack, or is that being heightened because of the fact that people are working from home, so they're on perhaps things like, well, Netflix perhaps more, and maybe Facebook? Has that really kicked them on, or are they just always out there?
Well, I suppose it's been a thematic then in the market we've been dealing with and thinking about for probably the past number of years, where these technology platform businesses have been able to continue to evolve, invest into their businesses, and that investment has allowed them to continue to grow successfully. And in that regard, they have been taking incremental market share from other providers. Now, they've either been doing that through natural growth or through acquisition. So they have got bigger. I think what we have seen is that even if we look at the UK market, for example, and think about how much retail sales have moved online, these platforms have been some of the platforms that have facilitated that. We think about us all working from home, Netflix subscriptions, downloading from Amazon, it's all increased. So incrementally, their businesses have been continuing to grow. And I think that's the distinction, that whilst the past number of years, economic growth has been relatively anemic, these businesses and businesses like them across the world have been able to grow their earnings significantly more than the market, and as such part of the re-rating that they've seen from a valuation perspective is wholly justified, because they've been getting a bigger part of the pie. And that's just if we look at the US, but then if we go to Asia and you look at what Alibaba has been doing, we look at what Tencent has been doing, we look at what ByteDance's Chinese business has been doing as well. It's like a global issue where we're seeing platform businesses continue to accelerate the growth that they've been delivering because they've been able to reinvest in themselves.
Fascinating. So, I mean, genuinely, more people in the UK, getting Netflix because we're at home and you're not going to the cinema and what have you. If you've got a true potential portfolio, potentially some of that activity is feeding through into the sort of position you find yourself in with regards to your investments as well. So, perhaps we don't think about joining those dots in our head when we're going about our, social lives or personal lives or home lives at the moment, but it all feeds through.
And very much so, if we think about our portfolios, we have exposure to those trends, both when they're in the US economy, but also when they're in Asia as well, where we have exposure to managers that own some of those Chinese assets as well. So we do have exposure to these broad and potentially very important themes as they're evolving over the next number of years in the portfolio.